Limited, the payments and e-commerce player in Southeast Asia. MercadoLibre, the payments and e-commerce player in Latin America. Axon Enterprise, the company behind both taser stun guns, body cameras, but most importantly, the software that runs on it. All three of these companies, as you can see, have stocks that are down markedly year to date, whether it's 25%, 30%, or more. But all three of them appear to be very, very healthy right now. So what's going on with these companies? My name is Brian Stoffel, and we're going to spend the next couple of minutes trying to figure that out. At the time of this recording, I own shares, a lot of them, of all three companies. I want to give a shout out to today's sponsor, Fiscal AI, and importantly note that if you click that top link on the show notes below, for this week only, and it actually ends on Thursday, you can get 25% off a year-long subscription to those services. So I'm going to go one by one through all these companies and try and explain what's going on. We're going to start with Limited, which just reported earnings before the market opened today, and the stock is actually up as a result of that. So on the top line, revenue grew 47%. 47%. That was way ahead of analyst estimates. Now, the only guidance that management gave was that they believe that GMV, which is gross merchandise value, for their e-commerce wing, which is called Shopify, to grow 25% for the full year. This is just one quarter. They affirmed that guidance, but it is worth noting that GMV grew by 30% during the first quarter. Now, earnings per share grew a little bit. They were behind analyst estimates. And in fact, if we look at margins on the face of it, this doesn't look very pretty. Gross margins declined. Operating margins were cut in half, and net margins didn't look good either. We'll get on why that was the case in just a minute. Excuse me. But it is worth knowing that free cash flow grew, although that's less meaningful because money, which is their fintech arm, is taking off. Net income was up slightly. The balance sheet is in great shape. $10.5 billion in cash, just less than $2.5 billion in debt. Let's go down the income statement to go over what exactly happened during the quarter. So as I mentioned, 47% growth of revenue, which is phenomenal. But the cost of that revenue was up 52%. That's not good. When the cost of revenue grows faster than the revenue itself, you get this, which is gross profit growing by less than revenue. You want gross profit to grow as fast or faster than revenue. But I did a little bit of the math and I dug into the gross margins for each segment. And remember, this is a three-headed beast, and so it's worth pointing out where this happened. For Shopee, gross margins from the first quarter of last year to this year contracted meaningfully from 38% all the way down to 33.5%. Now, the reason for this is actually pretty easy to understand. Shopee is making huge investments in their logistics and fulfillment network, and they're lowering the prices needed for your orders to get free shipping. Now, why is that so important? Because TikTok Shop is aggressively taking market share in Southeast Asia. But what TikTok Shop has in their virality and their distribution, they lack completely in terms of logistics. So while it might be a popular place to go and you might get induced to buy something on TikTok Shop, you're going to be waiting quite a while or paying quite a bit for that package to be delivered as opposed to Shopee. Shopee is doubling down on their ability to get that package to you quick, and that building a moat around the business that TikTok Shop isn't going to want to spend the money to match. Now, outside of that, the gross margins were actually pretty good. Money's expanded, although those are a little bit less meaningful, and Garena's expanded as well. It's also worth noting that while revenue grew 49%, operating expenses only grew 43%. That's great. And that's off of, your provisions for credit losses expanding quite a bit because the credit portfolio expanded. That said, it wasn't enough to overcome that gross margin decline, and so operating income itself was up just 30%. Net income, because of a lot of things in between the operating income and the net income that are less meaningful to the underlying business, was up less. It is worth noting that the number of shares outstanding did decrease just a little bit. Now, If you're an individual investor, I think one of the best things that you could do right now, between now and Thursday, is to head on over to Fiscal AI to get a year-long membership, because this is a site that I use every day. And I think anyone who wants to become a better individual investor should be using every day as well. That top link in the show notes below will bring you to the site where you can get 25% off of an annual membership if you go right there. So I'm going to head on over to Fiscal AI, and I've pulled up a whole bunch of things for C Limited. This first one shows a breakdown of where the revenue comes from. So you can see that e-commerce and Shopee is the #1 revenue driver. This orange section is money. That's its fintech lending, buy now, pay later arm. And finally, Garena. And it's worth pointing out how quick each of these is growing. So with Shopee, what we see here is that not only is revenue growing at a healthy pace, but over the last 5 quarters, the revenue growth rate has been accelerating. Thanks, free shipping. You're doing your job. That's great to see, because they're capturing long-term market share that they believe will stay because of the moat that they're building around themselves in logistics. If we look at money, while the growth rate has only been accelerating for 1 quarter, this branch of the company has been growing at over 50% for over a year. Now, we're going to get into some of the risks that are involved with growing your credit portfolio that fast in just a minute. And then finally, what we have here is Garena revenue. Now, that is the smallest part, but you'll see why it's one of the most important parts as well. And what we see is, again, a continued acceleration in revenue for Garena. That's not surprising given some of the things that we know. Now, that's the revenue view. That's what's going on with revenue. It's also worth pointing out where the company gets its profits from. And for that, we look at adjusted EBITDA, which isn't the cleanest metric in the world, but it's worth pointing out, where does the company generate its profits? Now, notice something here. Remember, Garena, the gaming unit, the Free Fire is their hit game. That was the smallest part of revenue, but look at this. It's the largest part of their profitability, followed by money. And then look at this. E-commerce, that was the big revenue driver, is actually the smallest profitability driver for the company. Now, that said, we can look right here and we see that Garena's adjusted EBITDA did fall. Okay, we don't love to see that, but it is worth pointing out that it's still quite healthy. I'm sorry, this is Shopee's. This is Shopee's profitability, their adjusted EBITDA. And so what we see right here is that in the year ago quarter, it was at 264. Now it was at 223. Why? Again, investments in their fulfillment and logistics network. This is to be expected. So that's where Shopee landed. What about money in terms of their profitability? Now, we see that their profitability is still growing. That growth rate is moderating a little bit. Nothing too much to worry about there. Finally, if we take a look at Garena, because Garena, believe it or not, is actually the main driver of profitability, a very healthy 25% growth there. So I really just wanted to give you an idea of, even though the e-commerce is the main revenue driver, it's important to know that it's the gaming for now that is the main profitability driver. All right, now let's dive just a little bit into each one of these. And what I want to do is I want to start out with bookings. Now, bookings is really important because this is money that Garena actually collects for people to play their game Free Fire today. They just have to wait to recognize that as revenue until people use up the credits that they pay for. And so it's a great indicator of where is revenue going in the future. And it's looking pretty healthy. Bookings was up 20% during the quarter, which means that that revenue should continue growing at a healthy clip moving forward. It's also worth pointing out the number of quarterly active users that they have. And this one did not grow by that much, but it's been growing pretty steadily now for almost 2 years. So this isn't too alarming. Those are the quarterly active users. This is a freemium model, so that there's some who are joining this for free. What we see with quarterly paying users is that that is actually growing at a healthy clip. So they're doing a good job of keeping their users and getting more of them to pay to play Free Fire over time. That's the gaming unit. Let's now just take a look at the e-commerce segment, starting out with gross merchandise volume. Now, this is really important because this is how much stuff gets sold on Shopee. And during the quarter, there was $37 billion worth of stuff being sold. Importantly, that was up 30% from the same time last year. And again, we see that over the last year, the growth rate for gross merchandise volume continues to grow, which means that the company is doing a great job of grabbing market share. We can also take a look at the number of orders that were placed on Shopee, and that continues to grow by about the same pace, which means that the average order is about the same. It grew by about 29%, 4 billion orders during the quarter. The last thing that I'd like to point out, is the take rate for Shopee. Now, take rate is important because what it means is of the percentage of gross merchandise volume, say you spend $100, what percentage of that does Shopee actually get to keep as revenue? And the answer is 13.7%, which is great. I mean, I can pull this back even further and show you that this has been expanding now for over 2 years. Their advertising continues to do well. Their logistics and fulfillment continues to do well. So this is looking very good, coming in at 13.7%. One other thing that I do think is worth talking about is that loan portfolio. So C Limited also puts this out, which is, I want to really focus on the top line here because you see the loan portfolio, the loans principal outstanding grew significantly from $5.8 billion to almost $10 billion in 1 year. But these non-performing loans past 90 days due stays at 1.1%, which is really, really important because this credit portfolio can be very profitable and can grow very fast, which is great. But there have to be guide rails because if they make poor loans, that can show up and really hurt the company. Right now, that is not appearing to be the case. So what about looking forward? Well, all that management said was that gross merchandise volume is still expected to grow 25% for the full year. Analysts expect overall revenue to grow 27%. That's not really an apples to apples comparison. Management said that adjusted EBITDA should at the very worst be the same as it was in 2025, so 0% growth. They'll probably come in ahead of that. Analysts expect earnings per share, which is a very different metric, to grow by 50%. For myself, what I am going to be watching moving forward is number one, gross merchandise volume growth, because we got to know that they're not losing this battle to TikTok Shop. Number two are those non-performing loans. While money can be a huge driver for both revenue and growth in profits, we've got to know that those are smart decisions being made. Number three are those gross margins for Shopee, which you have to calculate on your own, which I'll be calculating. I want to see those stabilize at around 30% at the worst. And number four are operating margins. I do think that the moat is widening, especially because of their logistics drive here is showing some success, and that the thesis is very much on track for owning C Limited. Now, all that being said, what about the stock's valuation? Well, there's a couple different things that we can look at to try and get a better beat on this. The first thing that we could look at, and I need to pull this forward here, is we can look at the company's trailing PE ratio. So right now, the company is trading for about 37 times their trailing earnings. If we look back over the past 3 years, the average is about 81. So comparatively, that looks cheap. 37 seems about fair for a company that's growing its top line at 49%. But maybe even better is to look at the company's forward price to earnings ratio. It's trading for just 23 times forward earnings. That seems very reasonable on an absolute basis, and it is below its 31 average over the last couple of years. Of course, I think the best way that we can try and get a feel for this is to do a reverse discounted cash flow analysis. So what we would do to do this is we need to know that C Limited has about $25.2 billion in trailing revenue. And I believe that once fully optimized, C Limited, it's hard because being a finance company, their free cash flow is artificially inflated. I think it's fair to say that they can get, let's call it 20% operating margins at some point in the future. So if we optimize those operating margins for C Limited right here, instead of free cash flow, 20% margin, if they had that today, would be equivalent to $5.05 billion in trailing operating profits. If we give them a 3% terminal growth rate, a 10% discount rate, we then just have to say, well, how fast does Sea Limited need to grow their revenue per year over the next 10 years to make this stock price be justified? And the fact of the matter is that the expectations are very low. I mean, if we look at this, we're talking about just basically break even is what they're expecting, which tells me that maybe a 20% optimized operating margin is a little bit high. What would happen if instead we gave it just a 15% operating margin? Well, then that would mean that we would have about, let's call this $3.7 billion in trailing free cash flow. So revenue to justify the stock price, again, only needs to grow about 5% per year to justify the stock price. It should be crystal clear from this that analysts clearly expect TikTok Shop to meaningfully either one, permanently take away market share from Sea Limited, or two, for them to permanently keep margins down where they could never hit that 15% bogey at some point in the future. Now, why do I say that? Because just look at the revenue growth that the company is expected to show over the next couple of years. Remember, 5% is what I said that they need. They're expected to grow 27% this year, followed by 22%, 17, 14%. This is over the next 5 years. Now, of course, those are just estimates and they've got to stretch out over 10 years, but that level of growth alone should justify where the stock is trading at right now. The big question is just around that moat for Shopee. If they build out that logistics and fulfillment moat, and if they can show that they can defend against TikTok Shop, this is a very, very cheap stock. So that is where we are when we're talking about Sea Limited. Let's now transition to Axon Enterprise. This is the company, again, behind police, stun guns, body cameras, and the software that runs on it. They reported their earnings last week, and they showed that their top line was growing 34%, easily beating analyst estimates. Earnings per share grew by about 50%, came in well ahead of estimates, and slightly beat analysts as their estimates. So, what's worth noting here is that gross margins did take a step backwards. However, operating and net margins expanded meaningfully. Free cash flow was negative, but it tends to be very lumpy as the company also is going to be building out a new headquarters. Net income grew, but it is worth noting now that because of a lot of acquisitions that the company has made to build out their 911 and dispatch options, their Dedrone acquisition, their Fusus acquisition, all of these things have created a situation where their balance sheet is upside down. So you need to have faith in management knowing what they're doing because they've got a net debt position of over $1 billion. Let's go down the income statement to kind of talk about what's going on. So total sales were up 34%, but the cost of those sales were up 39%. Usually that, again, would be a little bit alarming. It's worth pointing out that if we look at the products, so this is your stun guns, your body cameras, and also increasingly drones and anti-drone technology, those gross margins were down. However, it's worth pointing out that some of that has to do with supply chain and logistics issues and the company really investing a lot to make sure that they have enough to sell in the future if there are any future disruptions in the supply chain. The services revenue, margins contracting slightly is not, to me, a huge deal. Here's why. Because while gross margins for software are like magic when they're at scale, they are the opposite when you're getting started because all of the money that goes in the cost of goods sold is front loaded. And because the AI Era Bundle, which has things like Draft One included in it, are just starting to become revenue producing for the company, those margins are actually down. And I think over the long run, they should expand. Now, all that being said, that's why gross margins only grew 30% off of that 34% revenue growth. Now, that being said, operating expenses were only up 19%, which is great for leverage and why the company was able to swing from a loss on a GAAP basis from the first quarter of last year to a $29 million profit during this quarter. Overall net income was up much more because of some funny stuff that happens between those two lines, which doesn't really reflect the underlying business. The number of shares outstanding was up 1.2%. Now again, to see what else was happening during the quarter, we're going to head back on over to Fiscal AI. Pulled up a whole bunch of different things here. First, what I've shown is where the revenue comes from for the company. So this is Taser stun guns revenue. This right here is personal sensors. And personal sensors, think of this primarily as body cameras or dash cams. Then we have platform solutions revenue. Think of this, this should be body cameras. This platform solutions is more drones, dash cams, things like that. And finally, the really high margin software revenue from Axon Evidence, from 911 and Axon Records and things like that. So what do we see underlying this? Well, first, let's look at revenue growth for tasers. And what we see is that revenue growth came in at 19%, and this is for a very, very mature business. It wasn't as fast as it was during the fourth quarter because there was a new release, but this is still very healthy. So when it comes to the tasers segment, it's still looking very good. Next, we can look at how revenue growth showed up for the personal sensors. Again, this is mostly body cameras. And again, 23% growth is very healthy, so it was looking good there. If we look at platform solutions, now importantly, this includes things like drone technology. This was up 95%, and management said specifically on drones, it was a 5x growth in terms of revenue. There's a lot of big events happening that the D-drone technology and their drone technology, drone as a first responder, are being used for. And they called out the World Cup and several other events as being indicative and emblematic of this really taking off. And finally, if we look at the software solutions, which is really where the company gets a lot of its moat from, there was solid 35% growth. Maybe not as fast as it was before, but this is still growing very fast, 35% for the quarter. So those are the different kind of revenue streams that the company has. But there's a couple other things that are worth pointing out. The first one that I want to point out is the amount of annual recurring revenue for those software solutions, because overall, what we see here is that it has been able to grow at over 30% for a long time, and it continues to grow over that, coming in at about $1.5 billion in annual recurring revenue. This is high margin, moat building revenue for the company. So that looks really good. Another thing that I want to point out is future contracted bookings, because it came in at $14.3 billion. It was down ever so slightly because it can be lumpy quarter over quarter. But more important is that it grew 44% year over year. And this matters because when the future contracted bookings are growing faster than revenue, that means the pipeline for that revenue growth remains very, very strong. One final thing that I want to point out is the company's net revenue retention rate. I'm going to pull this back even further because this is really impressive what the company has done. You do not see this very often. What this means is forget about all of the new customers that Axon signs on, whether it's another police department, enterprise customers. The company said that they have a bunch of enterprise customers, one in particular, telecom, that they signed a big contract with. But forget all those new customers. This just says if you only focus on your existing customers from one year to the next, how much are they spending? If on average it's 100%, that means you're holding on to your customers, you're not getting them to spend any more. But look at this. This is accelerated from 119% back during the pandemic all the way up to 125%, which means that Axon could have not added any new customers at all, and they still would have grown their revenue by 25% per year, which is not only indicative of a widening moat, but their optionality in getting uptake on these new solutions that they have to offer others. Now, when we talk about Axon's valuation, we also need to keep in mind what analysts are expecting moving forward. So management upped their full year revenue guidance from 29% growth to 31% growth, which is music to investors' ears. They don't give any earnings guidance. What should we watch moving forward? Well, number one for me is those future contracted bookings. I love it when they are growing faster then revenue. Number 2 will be full year guidance. Management has a history of upping their guidance every single quarter. Number 3 are gross margins. They did take a step back, and I'm going to look and see if they're able to stabilize at least as the year moves on. And number 4 is any commentary on Dedrone, their AI era bundle, and their enterprise customers picking up more solutions, because those can be real drivers moving forward. Without a doubt, in my opinion, this moat is widening, and the thesis for owning this is very, very much on track. So how much should a company like Axon be valued at? Well, I don't think it's actually worth doing any type of multiple analysis when it comes to Axon. The reason I say that is because this is a company that is in no way, shape, or form optimized for profitability. And the reason for that is simply because they are reinvesting hand over fist in their business. Now, in the past, Axon has shown that they can have free cash flow margins of about 22 to 25% when they were just hardware. So I don't think it's too much of a stretch to think that over the next 10 years, they can hit 30% free cash flow margins. Now, if they hit 30% free cash flow margins, that would give them $900 million in trailing free cash flow. And given the fact that they have grown by over 30% for as long as I can remember, I have no problem giving them a terminal growth rate of 3%. In fact, that might be conservative. Now, if we give them these figures, how fast does revenue need to grow moving forward to justify this stock price? And the answer is, if we look here, well, it looks like about 14%. Now, let's call it 15%. Now, I know what some people are saying. Sure, Brian, $900 million in optimized free cash flow. This company hands out stock-based compensation like it's candy. And it's true, they do. It's a trade-off that I don't love, but willing to pay for because of the results that we see. But management has said that they will try and make sure that their dilution rate never goes above 2.5% per year moving forward. If we give them that 2.5%, because this is really saying about 14.5% ish revenue growth is what they need. If we add 2.5% on top of that, we're saying Axon needs to grow their revenue by 17% per year over the next 10 years to justify today's stock price. I actually think that's a pretty good deal. Now, you might not believe that's a good deal, but let's just take a look at what Axon's revenue growth has been like over the past decade. Ever since 2018, it has just accelerated the growth rate from 22% back then to 34% now. And remember, 17% is what I'm saying that the company needs to get. Analysts expect the company to get 31% revenue growth this year, 30% the next 2 years after that. I don't trust these estimates right now. I think that there are probably only 1 or 2 analysts that have put that in there. So even if we just shorten this up and we say, look, they need 17% over 10 years. We expect that they'll get at least 30%, although I think it'll be more than 30% per year over the first 3, which lowers what it needs to be for the rest of those years. And oh, by the way, it's worth pointing out that analysts have continually underestimated this company and revised their estimates upwards. That's why I think Axon is actually trading at a very reasonable multiple today. I do believe that they can hit that 17% average over 10 years mark moving forward. They have shown it in the past, and they've already got things in the hopper for them to continue to accomplish that over the next 3 to 4 years. Well, that leaves us with one more company, the most requested that we've gotten, and that is MercadoLibre. Now, before we get to MercadoLibre, I want to point out that if you enjoy breakdowns like this, then my program, Stock Investing Mentor, could be just for you. Stock Investing Mentor comes in 3 parts. 1 is an hour of live weekly training Thursdays at noon Eastern that are recorded for you to watch, where you get a new investing nugget every time. Number 2, 24/7 access to my real-life investment portfolio. And number 3, full-time access to a private online investing community. But if you join today, you'll get 2 extra things. If you click that second link in the show notes below, you will get 10% off of an annual membership, and you'll get instant access to our new tool, Stock Simplifier 2.0. And if you're wondering how Stock Simplifier 2.0 works, I can show you right here. This is not even yet publicly available. You can type in a ticker symbol, you get a business overview, a breakdown of revenue and where it comes from, a breakdown of the business quality with explanations for it, access to a deep analysis if you want that, and you get to make your own rating. You can go through all of this and you can say, well, what about the company's moat? Well, Stock Simplifier will tell you, hey, MercadoLibre, it's got all 5 moats. Low cost production is the one that's in question, but the rest of these, they look pretty good. Or what about the company's future growth potential? Again, you can go through, make your rating and say, hey, the growth potential looks great. It's a 5 and here's why. So if you're interested in Stock Simplifier as part of a bundle for free, a $300 value for free, and 10% off Stock Investing Mentor, click the second link in the show notes below to get that. Let's move on to MercadoLibre. This is not a perfect analogy, but the way that you could understand this is the Amazon and PayPal of Latin America. $80 billion company reported earnings last week, and revenue also grew about 49%, same as C Limited. And that is a misprint. They actually beat analyst estimates. Earnings per share did miss analyst estimates and came down for many of the same reasons that we see with C Limited. Gross margins, operating margins, net margins, all down. Why? 2 reasons. Reason number 1 is that they are investing in logistics and fulfillment. They have pressure coming from Chinese companies, from C Limited in Brazil, and from Amazon and Walmart in Mexico. Free cash flow is actually up, but that's less meaningful because this is a financial company now. The balance sheet, it is worth noting, the company does now have more debt on its balance sheet than cash. So again, you have to trust management, something that I do. I have owned this stock since about $83 back in 2013. If we go down the income statement, 49% revenue growth, unfortunately overshadowed by 57% growth in the cost of those revenues. Why? Again, 2 things. Logistics and building out their credit card portfolio in Brazil, Argentina, and Mexico. The reason that can be tough is because they don't start generating profits from those credit cards until about 2 years later, but they have to book their losses on those. There's the provision for losses immediately. So gross profit was only up 39% and operating expenses exploded. Again, the main reason for that, look at this, provision for doubtful accounts, that's their credit portfolio, more than doubled. And their investments in sales and marketing almost up over, let's call it 75%. So they're clearly investing in the future, and that's hitting margins right now. Operating income actually shrunk 20%. Net income shrunk about the same. The number of shares outstanding remained about flat. Again, if we head on over to Fiscal AI, we can get a better idea for all the different moving pieces here. So, two-headed beast, as I said. Commerce, MercadoLibre, and FinTech, Mercado Pago, Mercado Credito. And you can see there's it's a pretty 50-50 split between these two. The commerce arm grew at 37%, which is solid growth right now. The FinTech arm grew even faster at 48%. So from a revenue standpoint, nothing to worry about here at all. Let's start out by looking at the commerce side. So the number of unique active buyers during the quarter, and I want to pull this out a little bit more if I can. I need to go down here. The number of unique active buyers that the company has. Oh, and you know what? I want to put this on a quarterly view because I want to be able to look at how this is changing over time. The number of unique active buyers continues to grow, and it was up 26%. Now, that is really impressive because this is a company that's been in these geographies for a long time. They're still growing the number of people using it by 26%. Very good news. Now, what about gross merchandise volume, which you'll remember from C Limited just means the value of all the stuff sold. And look at this. I mean, it came in at $19 billion. This is more important, though. Since the holiday season in 2024, gross merchandise volume growth has accelerated. Thanks free shipping on lower orders in Brazil. That's why they are capturing market share because of these investments in logistics. 42% growth in gross merchandise volume is great. The number of items that were sold in total also continued to grow. This was up 46%, so people are ordering more things at lower prices, which means it's becoming more habitual over time. That's great news. And one final thing I want to show on the commerce side is the take rate. Again, if you spend $100, how much does MercadoLibre get to keep? The answer is it's increasing, and they get to keep about a quarter of that. Now, some of that's for logistics, advertising, listing fees, and things like that. The e-commerce side, margins are being pinched because they're investing in logistics, but that is the right move over the long term to keep the competition at bay. Now let's look at the fintech side. Now there's three different ways that the company makes money. The first is just fintech services. That's payment solutions that happen. The second is credit. So they offer some loans to both merchants and some of their consumers. They have the data to make smart credit decisions that other banks don't, which gives them a little bit of counter positioning as well. Those fintech, this first one is the fintech services, payment solutions, grew at a very healthy 32% during the quarter. The credit portfolio, as you can see, continues to grow very fast, up 75%. Credit cards are becoming much, much more popular. They will take time to show up as being a significant profit driver. Let's move on and look at the number of users on the fintech platform so that are using Mercado Pago and Mercado Credito. Overall, there are 83 million users. For many of these people, we're talking about the first time that they are using this. Oops, I've got the wrong one pulled up here. This is what I want to show. So their overall users not only growing, but we saw an acceleration in their growth for the first time in a number of years, which means that Mercado Pago and Credito continue to be very popular. Total payment volume, which is the total amount of money changing hands during the quarter. Look at this. It grew 50% to $87 billion on a total number of transactions of 4.6 billion, up 38%. So people are using it to make larger and larger payments, which is good news altogether. One last thing, as we did on the other side, I want to show you about the take rate. It came in at 4.6%, which is really great for the quarter. Now, it is worth pointing out that we got to look at that credit portfolio to see how it's doing. Now, first, you might notice that net interest margins after losses continues to shrink. 18% is still very healthy, but the thing to keep in mind here is, one, rolling out new credit cards does pull this down, and it is a very intentional decision that management's making, so that doesn't worry me, particularly because this is what I look at. The number of loans 15 to 90 days past due actually went down by 20 basis points from the same time last year, and those 90 days past due is down 40 basis points from the same time last year. Management does not give guidance, but analysts expect 37% revenue growth, 17% bottom line growth. I will personally be watching that growth in gross merchandise volume, the loans past due, increase, at least stabilization, if not widening of those take rates for fintech and commerce and overall operating margins. Moat, in my opinion, definitely widening. The thesis on track. They are choosing short-term pain for long-term gain. So what about the valuation of the company? Well, again, we don't have perfect ways of looking at this, but we could look at it's trading for about 41 times trailing earnings, which for a company growing at 49% seems pretty reasonable. It's below its long-term average. If we look at forward earnings, it's trading for about 37, 38 times forward earnings. Again, fairly reasonable for a company growing its top line at about that rate, but I think the best way that we can look at this is, again, to do a reverse discounted cash flow analysis. Now, when we do this, I'm going to give MercadoLibre, let's give them a 17%, it'll be between that 15 and 20%, a 17% optimized free cash flow margin. If we give them that, and we say that they could hit that when they're fully mature, that would give them about $5.4 billion in trailing free cash flow right now. If we give them a 3% terminal growth rate, which I think is conservative, a 10% discount rate, then this company only needs to grow their top line. I mean, look at this, by just goodness, like we clearly are going to have to lower this to have it make sense, but we're talking about just like 4% revenue growth per year moving forward. Think about that. 4% revenue growth is what we're talking about. Let's look at what the revenue growth has been over the last couple of years. I mean, it's been since 2016, let's say since 2018, it's never been below 20%. It's been above 30% for 1, 2, 3, 4, 5, 6, 7. We're in our 8th year now of above 30% revenue growth. And if we look forward, it's expected to stay above 15% over the next 5 years. And we're saying they only need to grow their revenue by 4% if they can get a 17% free cash flow margin. Clearly, there's a disconnect there. So I think this as well is very much a stock that is worth owning. Well, that was a monster session, and it's why I remain very bullish on Limited, Axon, and MercadoLibre moving forward. Don't forget, if you want to join Stock Investing Mentors, second link, your 25% off for Fiscal AI expires in just 2 days. That's the top link. Let me know what you thought of these 3 companies and their valuations in the comment section, and don't forget to hit subscribe if you want to know how these 3 companies did when they next report in 90 days. Until then, Brian, out.